Hello and welcome to another episode of A Stitch in Tax, Saves Cash, your trusted channel for breaking down complex tax rules into simple, practical insights that help you stay compliant and save money. My name is Olatunji Abdulrazak, founder and CEO of TaxMobile Online, your one-stop digital platform for tax education, tax coaching, and professional tax resources across Nigeria and Africa. Before we get started, make sure you subscribe to the channel and turn on the notification bell, so you never miss any of our weekly tax lessons, updates, and deep dive analyses. Trust me, you don't want to miss what's coming. Today's topic is one of the most important changes in Nigeria's tax landscape: how dividends are taxed under the Nigeria Tax Act 2025, specifically Sections 8, 9, and 10. If you run a company or earn investment income, advise clients, or simply want to understand how dividend rules now work, this video is for you. Let's dive in. First up, let's talk about Section 8 and how companies must treat dividends they receive. This section introduces two crucial rules. The first one, under Section 8.1, requires every Nigerian company that receives a dividend to recognize the full, gross amount as income in its books. Let's make this practical. Imagine your company receives a dividend of 10 million naira. The paying company will likely deduct a 10% withholding tax, which is 1 million naira, so you only see 9 million naira hit your bank account. However, the law is clear: you must record the full 10 million naira as income, not the 9 million you received. The 1 million naira that was withheld is your tax credit, which you can use later to reduce your final income tax liability. So, why does this matter? Well, it enhances transparency by ensuring all income is properly accounted for. It also prevents companies from manipulating their taxable income by only reporting the net amount received. This makes tax administration cleaner and compliance easier to track for the revenue authorities. It's a simple change, but it has a big impact on accurate financial reporting. Now, the second part of Section 8 is a relief for many businesses. Section 8.2 states that stock or scrip dividends are not taxable. What are these? A stock dividend is when a company gives its shareholders more shares instead of cash. So, instead of getting a naira payout, you get more ownership in the company. The law sees this as a reinvestment of equity, not a cash profit, so it's treated as tax neutral. This means no income tax is due when you receive these shares, and no withholding tax is deducted. This is fantastic news because it encourages companies to reinvest their profits, strengthen their capital base, and simplifies corporate group restructuring. It's a win-win for both the company and its shareholders. Moving on to Section 9. This section tackles a major historical loophole where some companies would declare huge dividends to shareholders even when they reported little to no taxable profit. This often raised red flags for the tax authorities, who suspected profits were being hidden or artificially reduced. Section 9.1 puts a stop to this. It says that if a company declares a dividend but has zero taxable profit, or if its taxable profit is less than the dividend it declared, the Nigeria Revenue Service will step in. The NRS will tax the company as if the dividend amount itself was its taxable profit for that year. Here's an example to make it clear. Let us say your company declares a dividend of 100 million naira but your tax computations show you made zero profit. Under Section 9, the NRS will assess your company for tax on a deemed profit of 100 million naira. This rule effectively prevents companies from distributing untaxed profits to shareholders and walking away without paying their fair share of tax. It's a powerful anti-avoidance measure. However, the law isn't designed to be punitive. It includes four major exemptions to ensure that legitimate business distributions are not unfairly taxed. First, if a company pays dividends out of its retained earnings that have already been taxed in previous years, those dividends are exempt. Second, dividends paid from profits that are specifically exempt from tax, like certain pioneer profits, are also excluded. Third is something called franked investment income. This is basically a dividend received by one company that has already had tax paid on it, and when that company passes it on, it's not taxed again. This prevents double taxation. Finally, Any distributions made by a real estate investment company, or REIC, are also exempt from this rule. These exemptions make the new regime fair and balanced. Now, let us turn our attention to Section 10. This section is specifically aimed at what are called closely held companies. These are typically private companies where control is concentrated in the hands of 5 or fewer individuals and their relatives. Section 10 is designed to prevent these individuals from using the company as a personal wallet to hoard profits and avoid paying personal income tax. Here's how it works. If a closely held company makes a profit but unreasonably refuses to distribute it as dividends to its shareholders, the Nigeria Revenue Service has the power to step in. The NRS can deem a portion of those undistributed profits as having been distributed to the shareholders. The key thing to note here is that the tax liability falls on the shareholders, not the company. The deemed dividends are treated as personal income for each shareholder, based on their ownership percentage in the company. So, if you own 40% of the company, you'll be taxed on 40% of the deemed distribution. This closes a significant loophole where owners could leave profits in the company indefinitely to avoid personal income tax. But the NRS can't just do this arbitrarily. The law requires them to follow a transparent and fair process. Any direction to deem profits as distributed must be issued in writing. This written notice must clearly state the date the distribution is deemed to have occurred, the gross amount of the deemed dividend, the withholding tax that applies, and the net amount attributable to each shareholder. This protects taxpayers from surprise assessments and ensures everything is done by the book. Furthermore, if the NRS suspects a company is being controlled by a small group of individuals, they have the authority to request the company's full shareholder records. This helps them determine if the company qualifies as closely held and if Section 10 should apply. Finally, Section 10 has a special rule for limited liability partnerships, or LLPs. For LLPs, the law automatically deems all profits as distributed to the partners at the end of the financial year. The partners are then taxed individually on their share of the profits. This aligns Nigerian tax law with global standards for taxing partnerships, where profits flow through directly to the partners. So, what are the practical takeaways for you? If you run a company, the message is clear: align your dividend declarations with your taxable profits. Always maintain clean and accurate records of your retained earnings to take advantage of the exemptions. For investors, stock dividends remain a very tax-efficient way to grow your investment portfolio. And knowing that franked investment income is protected from double taxation gives you more confidence when investing in dividend-paying stocks. For tax professionals, these new rules open up significant opportunities for strategic advisory. You can help clients structure their affairs, ensure compliance, and navigate the complexities of these new provisions. And for the real estate sector, the specific exemptions for REICs provide much-needed clarity and should encourage more investment in this area. In conclusion, Sections 8, 9, and 10 of the Nigeria Tax Act 2025 completely reshape how dividends are taxed in Nigeria. They introduce measures that promote fairness, eliminate tax avoidance loopholes, and strengthen the overall tax administration system. Whether you're a business owner, an investor, or a tax expert, understanding these rules is absolutely essential for staying compliant and making smart financial decisions. If you found this breakdown helpful, please show your support. Subscribe to the channel, turn on that notification bell so you don't miss our next video, and share this with other professionals and business owners who could benefit from this knowledge. Because here on A Stitch in Tax Saves Cash, we believe that one small lesson today can save you big money tomorrow. Thanks for watching, and I'll see you in the next episode.